He oversees around $10 billion as Chief Investment Officer at CCLA. Joining me now is James Bevan. Welcome, James. Good to see you again.
Great to be here.
So tell me, as we reach the first trading day of the month, what are your expectations for September?
Well, I'm hopeful that we're going to see better economic news, and we need better economic news to underpin markets. And, of course, the real problem in August was that the economic news, particularly from the United States, turned out to be relentlessly negative. And, of course, that pulled the rug away. What I'm really hoping is that the ISM, the indicator of sentiment on a forward-looking basis, turns out not to be as negative as some people had expected.
And how is that going to impact on your investment strategy?
Well, I think that actually the call is too fine to be really strong in terms of where one should be. I think that there is some continuing value in the bond markets, particularly in lending to corporates. But I think in equities, what one needs is to go for a strategy where one is looking for high, reliable dividend yields supported by ongoing free cash flows, because I think that is a very firm support to equity market valuation currently, but not being too brave, because if the economic news continues to be bad, I do fear that prices may recede a bit further.
And it's interesting because I was speaking to Michael Dix of Barclays Wealth just yesterday, and he was saying that right now he's favouring a strategy whereby his portfolio encompasses equities and bonds as well as a kind of hedge against deflation. What do you make of that?
Well, I'm less keen actually on buying bonds at current levels, because I simply think that the real yields, what you're left with after you take away inflation, are too low right across Europe, the United States and the UK. And I know that there are people who say, well, actually, we're in for a Japanese bout of deflation. I don't think that central banks will allow that to happen over here. I think they will print money, they will engineer persistently low interest rates for an exceptionally long period, and therefore I wouldn't be buying bonds currently in scale other than in the corporate markets, where I think the spreads for credit risk in some circumstances are still too high.
So where are you putting your money right now?
I think the safe end of the equity market is the right place to be. So I'm looking at good quality pharmaceuticals. I'm looking at Roche, looking at Glaxo. I'm looking at AstraZeneca, even companies in the States like Pfizer and Eli Lilly. I'm also looking at some of the global telephone companies. So I'm looking at France Telecom. I'm looking at Vodafone, companies that I see offering very significant cash flow. I also think this is the right moment to be going back to the banks. And I know that they've taken a hell of a pasting in sentiment terms. But actually, if you look at the quality of the balance sheet of companies like HSBC, Banco Santander, Standard Chartered, I see real opportunities for forward-looking progress.
So US and European banks?
Absolutely.
So where do you think equity markets in general could be headed as we go into the second half of the year? We've seen a great deal of volatility. Is another downturn imminent?
Well, I don't believe it's imminent. I certainly think there is a chance that prices grind lower, but I think that the underlying trend should be upwards. I think the real problem all of us have is, of course, we can determine where value resides. We have very little control over price, and sentiment is very fragile. If the ISM numbers come out below 50, I think that everybody's going to be extremely cautious. I would actually only turn cautious if the number turns out to be below 45, at which point I think we will be facing a double-dip recession. At the moment, I think that sort of outcome has a very low probability.
Nevertheless, you mentioned a string of poor economic data in both Europe and the US, particularly the US lately.
Absolutely.
I mean, you say that you expect a further round of quantitative easing, and so what do you think? I mean, government debt on both sides of the Atlantic, I mean, how are you factoring that in, and the risk that poses to future growth?
Well, I think the real challenge for the bears, actually, was the extent to which there was a real demand for the bond markets. And I think that demand has come from three parts. Clearly, there is underlying investor demand from people who genuinely believe that we're in the grip of disinflation or deflation for an extended period. I don't think that that is correct, but clearly there are people who have that view. The second, very interestingly, will be the commercial banks. And the commercial banks have, in effect, had a free carry trade because they've been able to borrow at the T-bill rate and lend back to the government, pick up the margin because the yield curve, the difference between lending and short and long, is still significant. And they are rebuilding their balance sheets at the expense of the taxpayer who's supporting the issuance of debt. The third issue, of course, is we have continued de-risking by pension funds, life companies and insurance companies. All are being told that actually mark-to-market is really important, and therefore equity risk is quite difficult to take.
Thank you so much for your time. Appreciate it. James Bevan, Chief Investment Officer at CCLA Investment Management.